Good morning. Good morning, everyone. Everyone can hear me fine? Anyone here is parent? How many hands? Show of hands. How many are parents? All right. Now, how many hands are those that are parents of teenagers? All right. I feel your pain. I feel your pain. I have two teenagers at home, a 15-year-old and a 13-year-old daughter, McKenna. In fact, she was just texting me right before I took stage to say good luck. Isn't that sweet? Of course, then she asked another gift that I could bring home for her, but that's the way it is. I bring up my daughter and my children in part because if you are a parent, or if you're an uncle and aunt, or if you have nephews, family members, you know that one of the jobs of a parent, a duty, in fact, is to help them through school as you can. And about a year ago, my daughter came home from school. I came home from work. It was a long day at work, and she asked me a question. Hey, Dad, can you help me with my school essay, with my class essay? Sure, happy to, McKenna. And I said, well, what's the question? She said, it's simple, Dad. You should know the answer. She says, the question is the world getting better? Now I sat there again. I've been at work 12 or 13 hours. Haven't eaten since the morning. And my first attempt at response was to say, as a lot of things, is, have you asked your mother? Of course, I didn't, because I've been married successfully over 20 years. That's a big reason why. But again, think back to my daughter McKenna's question. Is the world getting better? How would you answer that question today? How would you answer that question? My first thought was there's a lot of things to point to that have been positive just over the past several years that are developing in the world. If you look at the world economy, the labor markets across many markets are increasingly tight, more job opportunities for those that have been out of work. The financial markets have clearly responded and rebounded over the past 10 years. And in many parts of the world, the banking sector has improved. So in that sense, it would be better. But one of my habits and one of my favorite things to do at night is to also watch the news with my two children. And I can tell you, if you watch the news, the world certainly doesn't seem like it's getting better. I mean, just in the United States, over the past several years, the increased tension between the U.S. and China, increasingly we still have yet to resolve Brexit. And you look much bigger picture, we all see the sobering rise of issues, related issues of income inequality and populism. So if you can recall, you can imagine me again back at my kitchen table with my daughter anxiously waiting for my assistance with her school essay. I actually can still recall me having my hands over my head saying, I'm going to fail the 7th grade, right? Fail the 7th grade. Difficult question. Is the world getting better? So what was my answer to my daughter's question? Let me share with you that before I share with you that answer, I'd like to first answer, I think, a more pressing question today. And that is not, is the world going to get better, but rather, is it going to get markedly worse? In other words, is the world going to fall into recession? Right? The theme of our outlook this year, which we put together several months ago, it's a paraphrase of a boxing analogy, down but not out. Right? So how many of you have ever been to Philadelphia? Right? Anyone been to Philadelphia, United States? That's where I was born and raised, and where I currently work outside of Philadelphia, the headquarters of Vanguard. If you've ever been to Philadelphia or read about the city of Philadelphia, Philadelphia is really only known for three things. Right? One is the home of the Liberty Bell, the founding of the United States. Secondly is somewhat of a local delicacy called the Philadelphia cheesesteak. And the third is the home of where the film of the Rocky movies were. Right? So if you've heard or watched the Rocky movies, I think it's appropriate to think about the character Rocky in terms of characterizing the global outlook this year. Because if you know anything about a Rocky movie, you know that Rocky many times wins the fight, but he does not look like he won. In fact, he takes quite a beating. And that, in effect, will be the global economy this year, down but not out. Rocky will hit the floor. He will not be knocked out, but nevertheless, it will not necessarily feel like a wonderful year, right? So let me share with you three reasons why we will avoid recession in the United States. We will clearly avoid a hard landing in China. And with those two factors, we will avoid a global recession, which clearly would be traumatic for the global economy. So three reasons why. The first one clearly is that, if you have your clients, it's been a major topic, this question of recession, right? One indication of how much it is top of mind is this is a simple graph of all the web search activity on the word recession in the world on Google over the past 5 years. So everywhere around the world, this is how many times someone in the world has searched on the word recession. Now, these are analytics based upon Google Trends. Now, the one cool thing about Google Trends is you can actually see where in the world that word is being searched on the most. And it turns out that over the past several months, where in the world it is being searched on the most is in the city of Washington, D.C. in the United States. Now, I don't know if those in Washington, D.C. are looking up the definition of recession or, respectfully, how to create one. But nevertheless, it's clearly top of mind, right? Clearly top of mind. And it's been reflective, I think, in the financial markets. This is effectively a way to say what are the odds that the financial markets in the United States and increasingly around the world are pricing in or assessing the odds of recession. This is an algorithm based upon equity market volatility, the shapes of the yield curves around the world, the level of interest rates, commodity market volatility. All say that the markets have not fully priced in the odds of a recession, but you can see it's the most elevated we've been since the wonderful times of 2009, nearly 10 years ago. So it's a significant risk. In my mind, I will share with you 3 reasons why that line will not rise further. All right? The first reason, and this has to do with the United States, and that simply is the labor market is strong. And one of the themes that we at Vanguard have proposed over the past several years in our outlook, and if you have the opportunity to read them over the past several years, you would find this similar vein throughout our research, was that we would be in a low-growth world, and yet in a low-growth world, we would be increasingly in a world of full employment. And generally, those two concepts are not associated and put together. This is an indicator, in my mind, the best indicator, more so than GDP growth, of the strength of the U.S. labor market and the U.S. economy. It is simply a ratio of the number of unemployed Americans relative to the number of job openings. And for the first time since World War II, since 1944, think about what the U.S. economy would have looked like in 1944, with effectively a third of the population fighting wars overseas. It is not since that time that the labor market has actually been this tight, 1944. There's actually more job openings in the United States this morning than there are unemployed Americans. Now, unfortunately, those two indicators don't always match, but if they could, we would actually have a 0 unemployment rate. So this does not necessarily guarantee that a recession cannot transpire. It just means that the level of shock resistance, the level of the shock, I should say, that has to hit the U.S. economy to generate a recession has to be larger than in any time over the past 5 years. So the bar is higher to generate a recession, and so that's, in one sense, good news. The secondly is that despite the strength of this labor market, the U.S. economy is not overheating, and that has been a second secular theme for us at Vanguard, that we could be in a world of full employment and actually modestly rising wages, and yet we would not see, and our belief, we will continue to not see a rise in inflation. And that's actually a good thing. So the second reason why the odds of a recession are far from 50%, right? Far from 50% is because the U.S. economy is not overheating. The most important line on this chart is that 2% line, is that straight line going from left to right, because that is the target inflation rate that the Federal Reserve wishes to have. Right? And as you can see, for the past several years, it has been consistently below that 2% line. And this time last year, we thought it would rise modestly to that 2%, but it would be very unlikely to go much further. Right? And the biggest reason for that is the research we have done. We are of the firm belief that inflation dynamics around the world, not just in the United States, but long ago, as recently as 2 decades ago in Japan, that the dynamics around inflation have changed fundamentally, and that when we understand that, it has strong implications for where interest rates go. Right? In our belief, two things matter, and which is why inflation in the United States is unlikely to go materially above 2%, even to 2.5%. One reason is inflation psychology. Most consumers, businesses, investors in the United States do not believe inflation will deviate fundamentally from 2%. And when you have that strong belief across society, it by definition means that the likelihood of businesses passing through, whether it's higher tariffs or higher wages into higher prices for we all pay as consumers, is less likely. That's actually the dynamic that central banks want, and because the Federal Reserve has earned that credibility, it means it is very difficult, even with an unemployment rate that could be as low as 2%. Even if we had an unemployment rate of 2% in the United States, you would not generate an inflation rate well above 2%. That's the power of inflation credibility and psychology. And secondly, and more importantly, and I'm proud of the team we have at Vanguard because I think we've been one of the first to actually quantify the fact that it is increasingly difficult to have high inflation in the world with the increasing spread of digital and computer technology. If you think back just 15 years ago, any business in the world used on average 8 cents of technology, computers, digital technology, to generate $1 of revenue. 8 cents of technology for $1 of revenue. Today, the average company in the world uses 20 cents of technology to generate that same $1. That's important because we all know what the relative price of computing power continues to fall throughout the world through the power of Moore's law. And so you put those two factors together, that means that inflation is unlikely to break out above the 2% range over the coming year. And that is very important because if that is true, and we firmly believe it is, that means the Federal Reserve is unlikely to raise rates further. And that is a very important factor because without exception, since World War II, every single recession in the United States, and with that, a recession in the world, has been at least preceded by, not necessarily caused by, but preceded by a Federal Reserve that has raised its short-term interest rates well above the rate of inflation. And so the odds of a policy error by the Federal Reserve are much, much lower than they would have been just 10 or 15 years ago. So that's a positive factor. Very unlikely that the Federal Reserve will raise rates above the high 2% range for the foreseeable future. I mean for the next 10 years. And that's a positive in terms of trying to avoid recession. And then the third factor, and it may seem counterintuitive, but I believe that the recent financial market volatility we have seen around the world over the past 3 months have reduced the odds of a recession. And why I say that is this picture is an indication of whether or not the U.S. stock market, which has been the strongest performer in the world over the past decade, whether or not the U.S. stock market is over or undervalued. The fair value that we estimate through time is the gray line. And that's an indication effectively where the S&P 500, its price divided by earnings, so think of the cyclically adjusted PE ratio, that's what CAPE stands for. Its cyclically adjusted PE ratio, the fair value of the stock market can vary through time based upon the level of interest rates, the level of inflation, the level of growth. And that methodology was published this past year in the Journal of Portfolio Management. So if you're interested in the details. That's a powerful predictor of where the stock market does go in the next 1 year, 5 year, and 10 year. And on a 10-year basis, we have at least a 70% probability of predicting what the average stock return will be over the following 10 years, when that blue line deviates outside of that gray band. And I point that out is because since 2009, if anything, the equity market was significantly undervalued, which is why Vanguard was fairly constructive on financial market returns despite a low growth environment, because those two concepts need not be equal. But as you can see, in late 2017 and throughout 2018, that blue line was above that gray area. And that was increasingly growing a risk that the Federal Reserve would be much more aggressive and restrictive because they were concerned of what they would call financial stability, which is a fancy way for saying stock prices have gotten ahead of themselves, right? And so that was another factor that could have increased the odds of recession this year because, again, aggressive Fed generally has generated recessions in the United States and has helped generate global economic slowdowns. So that's actually good news. That meant that the odds of a correction this time last year were extremely elevated. There are much more normal historical expected returns. And so that's a positive benefit. So in my mind, those three factors have reduced what we were most concerned about in the risk to our forecast. Our forecast has been for a significant slowdown this year in the global economy, but yet we would avoid recession. But if you asked us, and we published several months ago, if there was a risk to our forecast, we came up with 3 material risks. They would say, if we are wrong, and we have been wrong in the past, if we are wrong, why will we be wrong? What are the risk factors that would have to materialize for us to generate a recession? And these were the 3 that we had when we assessed it as a team, right, Matt, in October 2018, so several months ago. As I said, the biggest one we were concerned about at the time was aggressive Fed that takes the Fed funds rate, which is in the high 2% range, well above 3%. It was a scenario that the bond market, U.S. Treasury market was starting to price in. Chairman Powell was not helping the matter by saying that the Fed policy was well below neutral. Since that time, I think that the odds of that risk have been eradicated. And I would assess that the risk of that scenario close to 0%. So that's a good news. That's another reason why we should avoid recession. However, we're not out of the woods yet. So the fight, if I go back to that boxing analogy, the fight is not yet over. The big round we have right now is obviously the trade tension between the United States and China. And why we remain concerned about it is because those 2 risks I have to the right of the page, those 2 risks are correlated. Because this time a year ago, our leading indicators for China rolled over significantly. And we're pointing to significant slowdown in China's economy, indicating that growth would very likely be in real time high 4% to low 5% range. I mean, it's stated it's roughly 6. I can tell you they're growing at least a percentage point lower. We know that arithmetically. And so that was already a risk before the rise in the trade tensions over the past year. So then the question is, how does that risk and how does that scenario play out over the coming year? Okay? I will use one chart to convey and to provide some context to how we view the trade tensions between the United States and China, how they will play out, and how that risk will unfold this year. And in fact, I will try to give you even what I believe is the day we will know much more definitively whether the world avoids recession over the next 12 to 18 months. Try to even give you down to the day, right? This is an indicator that we watch closely to convey near-term risks to any market in the world. It's a measure that you see in the title of the page. It's called policy uncertainty. It's actually a real-time algorithm, natural language processing that captures all the words in the media for any market. So if it's for the United States, it's websites, it's publications such as New York Times, and it pinpoints in real time how many times economic terms are mentioned in the context of other terms such as uncertainty, aversion, things that we know through time. The higher there is uncertainty in the environment, and there's always a level of uncertainty in life, but the more uncertainty there is in the business environment, what happens to future investment and hiring decisions of the following 6 months? It clearly recedes. And so this is actually a very powerful proxy that we use at Vanguard to assess the risks to the near-term growth trajectory of any market. And as you can see, what I did is I indexed them to the same level where policy uncertainty is evolving in both the United States and China. So with that as context, where do you think the trade war, at least as of right now, which economy is suffering more from the trade war? I think that's a clear indication of why we will continue to see weaker than expected growth coming out of China. That is not intended in any way, shape, or form to be a political statement. It is simply an economic assessment of the headwinds that China is facing, because this is in a context of policymakers having already tried to engineer a slowdown in parts of China's economy given the rise in leverage over the past decade. And you overlay this policy uncertainty, tells us, and it has told us for the past year, that the slowdown this time in China is much more unnerving. Because this slowdown in China we are seeing Right now, we assess that China could be growing as low as 4% real time. Just think about that, 4% real time versus a normal 6 to 6.5%. That's a 2 percentage point drop, which largely explains why we continue to see weakness out of countries such as rest of Asia and Germany, right? It's because China is growing much weaker than I think what is officially reported because of the rise of this uncertainty, because this has damaged, at least to the present, Chinese consumer confidence. And so the slowdown we have seen and picked up in China is related to the consumer, which is different from the previous decelerations we have seen in China in the past. If you want one telling statistic why I believe that China's economic weakness is perhaps worse than we think, is that for the first time in nearly 25 years, auto sales in China contracted. They actually fell. That is not, respectfully, that is not an economy growing at 6.5%. It's simply not. It's not mathematically possible. So that is context. You will also, I could also show, we updated those lines today, that policy uncertainty in the United States is now rising too. And so the United States will not be immune to the weakness we have seen, and I think we'll see over the next several months in China as well as Europe, right? The United States has been the strongest relative performer of the economic global picture over the past 2 years, but it is not immune from the headwinds overseas, far from it. And so why does this matter in terms of the assessment of the trade outlook? Why this matters, this means that we will see very likely three things. One is that line in the United States has not, I don't believe, risen to the level that we will see a trade deal March 1st. And so we will very likely see the trade tensions between the United States and China, those tariffs unresolved at March 1st. That means, if we're right in that assessment, that those red and blue lines will continue to rise over the next several months, which means very likely that we will probably see a rebound in financial market volatility. And I think at that point, hopefully before April 1st, we will ultimately see, I think, a trade resolution between the United States and China. Because I think we will perhaps need to see a little bit more economic weakness in the United States before I think we see a greater incentive, respectfully, to see a trade deal between the United States and China. So that's our baseline. I think we certainly feel confident in that assessment. It's something where, again, down but not out. We will have volatility in the United States and China and disappointment across Europe, but things would have to get markedly worse. And if you want a real-time indicator to assess where the risks are, if the world is going into recession, you could go to this website, policyuncertainty.com, and it's probably the best real-time indicator in this moment, because this is picking up the trade uncertainty in both economies. The higher those lines go, the more the elevated risk of recession in the world. But that line should crest in a few months, and ultimately we will avoid a recession. So with that, I gave you, I hope I gave you a somewhat compelling case that things should not get materially worse this year. They shouldn't get materially worse. But I still did not answer, respectfully, I did not answer for you my daughter's question. And that is, does the world economy get materially better? Does the world get better, right? And when my daughter asked me that question roughly a year ago, if you know anything about me, you would know I'm generally a very optimistic person. It's how my mother made me, my parents made me. But when I looked into my daughter's eyes, I was strongly inclined to say, because you want good things for your children, but I was strongly inclined to say, McKenna, it may not get better. And why, as an economist, was I inclined to say that to her is because I have seen the fall in this line. This line is effectively the rate of economic potential in the world. Simply put, it is a ratio of GDP per person, GDP per capita around the world. And many economists, myself included, we tend to focus on the short term in terms of assessing risks and trends in the global economy. I mean, I just spent the past 20 minutes talking about the risk of recession for 2019, an important question. But I think when we do that as economists, we tend to risk missing the big picture. And this is the line that matters for the next 2 decades, because this is the line that drives opportunity, it drives progress, and it drives standards of living and improvement across the entire world population and across humanity. This line is economic potential. Another way to think about it is to say this is the rate of commercial innovation. Output per person is productivity, which effectively is the rate of technological progress and innovation. And since the late 1990s, the trend in this line has fallen consistently. Since the late 90s and the commercial rise of the internet, ever since that game-changing idea spread throughout the world economy, we have seen a gradual but consistent fall in this line. And this is the line, besides my teenagers, this is the line that has kept me up at night. So the key question is, if the world is going to get better economically, and not just for a select few, but for most, that line has to rebound and start to turn up. Now that's the key question. When, if ever, does it turn up? Now, some of the best and most thoughtful economists in the world, economists that I highly respect, increasingly say that that line will not turn up. I mean, for years, if not decades. This is the reason why we have things such as low R-star in the world, why we increasingly have low expected returns in our clients' portfolios, and why the opportunity and the concerns of moving up the economic ladder have fallen for many because of the rate of innovation has declined. So key question, does this turn up? Many smart economists, as I mentioned, individuals such as Larry Summers or Paul Krugman, have offered hypotheses such as secular stagnation, that innovations and ideas today are not nearly as impactful as they were 2 or 3 decades ago. Again, some will say, hey, all the apps you have on your cell phone right now, they're not nearly as impactful for global growth and global opportunity as, say, indoor plumbing. Now, if I ask my children, I think that's a fair statement. If I ask my children which one to pick, indoor plumbing or apps, they will probably pick the latter. But it was the former that clearly drove economic growth and helped drive more opportunity. So again, this is the seminal question I believe that we face as world citizens over the next decade. Does this rate of innovation ever turn up? And increasingly, many believe we do not. Now, if you ask any economist in the world, and they would ask you, when will it pick up? Can you predict it? Every economist in the world, myself included, I would not be able to give you an answer. Because economists, for 200 years, have been unable to predict the rate of innovation, unable to predict the rate of productivity, which in the long run drives all growth. Just think about that. Now, why have economists not been able to predict the rate of innovation in the future? The reason why is to be able to predict the rate of innovation, of technological progress in the world at a macro level. You need to be able to predict where great ideas come from at the individual level, which means you need to model human creativity. Human creativity. That's why it's so tough to do, which is why this trend in this line is so perplexing. Because if we could explain the process of human creativity, where great ideas come from, we would have some sense of when, if ever, this line will change. So let me ask you a question. I won't ask you to close your eyes, but if I asked you, what is the image that comes to mind when I say the formation of a great idea, where great ideas come from? What sort of image comes to mind? This is the image that has always come to my mind since I was 6 years old, starting to go to primary school. This is the image that came to my mind when someone would say the formation of a great idea. Just that this is Sir Isaac Newton, where legend has it right now, just then, he discovered the law of gravity after that apple that's on the bottom left of that screen just hit him on the head, right? And so as the story goes, Sir Isaac Newton's great idea of gravity, in fact, every great idea in the world follows the same story. It's a story of solitary genius sitting by themselves who in a streak of genius, a story of spontaneous combustion, in a light bulb moment, in this case an apple, plunked Sir Isaac Newton's head and he discovered the law of gravity right there on the spot. That is the story of creativity and hence innovation I have always heard and I always believed until now. What if I told you that entire story, it turns out, is a myth? That in fact, it's never been true. I always thought that that apple was the most important image on the screen, but it's not. Look again at the picture. The most important image on that screen is on the right of the page. What is Sir Isaac Newton holding? It's a book. That book symbolizes human knowledge. It was all the other great ideas that had been previously created by mankind that helped inspire him, that with his human mind led to his great idea that day. Great ideas never happen in a vacuum. They are of a function of the other exchange of knowledge and the exposure to other ideas that we are all exposed to in this life, that with a little extra luck and creativity can lead to the next idea, lead to the next idea. In fact, when you look at any great inventor in the world and the story of any great invention or any great inventor, you find the same story. It's not one of spontaneous combustion and a light bulb moment. It is one of exposure to knowledge and the trade of ideas that lead to new ideas. If I asked you who's the greatest inventor, in your mind, right? What's the sort of image of a great inventor, right? When I was asked what's one of my favorite inventors, I go back to where I said before, I'm from the city of Philadelphia, United States. I should have said Philadelphia is also known for perhaps a fourth famous thing or individual, in this case, Benjamin Franklin. Right? That's a great inventor that comes to my mind, someone who was extremely creative. And I always ask, why was Benjamin Franklin so creative? It's not just because he was smart. I know a lot of smart people in this world, a lot of smart people in this world. I don't know anyone who was as creative as Benjamin Franklin. So how was he so creative? How did this individual who had no schooling create the lightning rod, experimented with electricity, discovered the jet stream, and bifocals, all within a 5-year period? How did he do it? Well, it turns out when you start to explore where great ideas come from, you start to find that power of the exchange of knowledge. And the more we explored, the more that we found Benjamin Franklin had a growth mindset, something you'll hear from Rob in just a little bit, that he sought out other ideas and read as much as he can that helped inform his ideas. And it wasn't solitary genius. In fact, we looked at the 5,000 letters that Benjamin Franklin wrote or received during the height of his creativity. Just think about that. The average human being in the late 18th century received at most 2 or 3 letters over the course of the year. Benjamin Franklin received and wrote over 5,000. This was his knowledge network. This symbolizes the lines of all the letters that he sent and received just in the 5 years during the height of his creativity. It was exchanging ideas with different individuals, some of whom he didn't know. He would seek out people with different perspectives. He would actually, half of those were requesting the latest books from Europe, and from Italy and France and from England. This was an individual who had a growth mindset that helped inspire him, which gave him ideas for his next idea. This is why Benjamin Franklin was so creative. And I mentioned to this because the more we explored, the more that we found this same sort of knowledge network and multiplication of ideas explains the rise of game-changing ideas that alter that previous line that I showed you. We looked at the first patent for the iPhone, and I could show you the same picture, but a map with 7,000 nodes of all the ideas that were critically important to the patent for the iPhone. Building blocks of previous ideas without which the cell phone you have in your pocket would not have been possible. One idea leads to another, which got us thinking. If we can trace the exchange of ideas and where influential ideas in one field are rising today, if we could do what we did for Benjamin Franklin's creativity, and if we could do that for all of the ideas in the world, if we could do it for all of them, then we could predict the rate of innovation in the future. We could predict it. And ladies and gentlemen, I will share with you how we did it, because we believe we created the world's first leading indicator of innovation. Not where innovation will be tomorrow, but believe it or not, where innovation will be 5 years from now. I know it sounds crazy, but it's true. Let me share with you how we did it. We did 3 things. We call it the idea multiplier. The first thing is we grabbed a lot of data. We accessed every journal article, every patent, and every book that has been written anywhere in the world, all of them, over the past 30 years. That's a lot of data. And we didn't just look at all that information. We counted what's in the back of any book or any journal article. What's towards the back, right? It's works cited, it's a bibliography, right? Those are the ideas that stimulated and were fundamental to the creation of that idea, whether it's the next paper, the next patent, or the next journal article. And that material is important because often those ideas I just mentioned, embodied in a journal article, embodied in a medical study, are ideas that have yet to be commercialized in the world. They have yet to lead to a new product. They have yet to show up in GDP. That's because they're being debated in an R&D lab. They're being debated on a university campus. They may be one of, if we're a research team, we may be kicking around ideas, thinking about what it could lead to, a new product, new opportunity, new business line. They are leading ingredients of what ultimately transpires in the world. And we captured all of that across 1,000 industries and across all countries, over 2 billion records. And we used big data techniques to extract from all that information. And we wanted to just isolate the influential ideas because, quite honestly, a lot of ideas are not really good ones. And any time in the world there's over 1 million patents filed, whether it's in the United States or in China, the vast majority of them are never renewed, which means they were not influential. They did not matter. They did not move the dial and lead or influence one of us in this room to come with another more important idea. So we just screened for only influential ideas in any field. Influential ideas meaning a work that has been cited at least 100 times somewhere in the world over the following several years. I'll give you an example. One of the most cited journal articles ever written came out of the field of biology in the 1950s. The authors were Crick and Watson. And the title of the journal article was A Double Helix, DNA and its importance in its structure. That's an influential idea. Those are the sort of ideas we want to capture because when those ideas originate, they lead to a whole new founding of different new products, new industries, new jobs, new business opportunities. And we did all of that, and we traced it over the past 30 years. This is what we created called the idea multiplier. So let me walk you through and show you what it means. To give you some sense, let's go back in time to 1980. In 1980, the idea multiplier was 40 to 1. Now, what does that mean? That means if there was one influential idea in the world created in 1980 in any field, it could be in marketing, it could be in medicine, it could be in computer science, it could be any field. If there was one influential idea over the next several years, there was 40 additional significant ideas created. So the ratio was 40 to 1. So that's just for context. Okay, that sounds great, Joe. You'll notice that through time, throughout the 1980s and in the early 1990s, the idea multiplier rises. It becomes, you can't tell by the scale, it jumped over 100 to 1. And we wanted to know why. In 1992, 1993, it starts to pick up. It turns out that the idea multiplier was generally flat across most industries except for 3 fields. The fields were computer science, telecommunications, and electronic equipment. Now, with the benefit of hindsight, it now tells us that in 1992, those ideas multiplying, being debated, being challenged, being accepted in all those ingredients ultimately led to 5 years later something we now know as the internet. It told us the internet was coming. It didn't necessarily use the word internet, but it said those fields were highly charged. There was human creativity. The knowledge network was expanding, and something big was coming. And you can actually see the idea multiplier slow down in the late 90s. I wish I had this in 1992 to invest, but I clearly didn't. See what it has done for the past 15 years. The idea multiplier rose through the early 2000s. It's been stuck roughly at a ratio of 200 to 1. Think about that. Ideas have not been multiplying at faster paces. And you need to have the rate of innovation and the rate of world growth to accelerate. We need to have ideas multiplying at faster paces for growth to accelerate. This signal said that something that we now know or refer to as the new normal was coming in 2004. Because since 2004, the idea multiplier has been stuck at 200 to 1. Now, I want to share with you what has happened just over the past 18 months. That data, it says 2015, but it was stopped in 2016, right? What has happened over the past 18 months? This is the line. And I kid you not. It is now 400 to 1. Something is happening in the world where ideas are multiplying at an accelerated pace. And when we looked at why it's accelerating, we are finding that the exchange of knowledge and the ideas are multiplying across fields and across countries faster than ever before. In 2004, the average idea, influential idea in the United States, cited no ideas outside of its borders. 0. 80% of the ideas in the United States was effectively closed to the world. Today, 80% of the ideas in the United States cite work somewhere else in the world, Japan, Europe, and increasingly China. China in 2004 accounted for less than 1% of the world's influential ideas. That line is now rising because China's share of influential ideas is growing to 20% and rising. And so while my colleagues in the profession respectfully say and fear that globalization has peaked, when they define globalization in terms of trade and the trade of commodities across borders, I would say, ladies and gentlemen, I would offer that when we define globalization more broadly and more powerfully as the exchange of ideas that drives innovation, globalization is not only hasn't peaked, it's actually accelerating. And that's ironic given the recent commentary of tariffs around the world. So what does this mean? Ladies and gentlemen, over the past several years, as I've talked about the global economy, and when I've been asked, are there any bright spots longer term? Is there any upside risks to the global economy? Quite frankly, I have had 0. I have been hard-pressed to find anything that would lead to a material shift, positive shift in the global economy. A long list of downside risks, not many on the upside. But let me show with you again, let me show you that blue line I showed before, which started McKenna's question. I've just pushed it further back in time. That's been the rate of commercial innovation in the world. Now let me take that idea multiplier, which I said should lead commercial innovation. Let me take the growth rate in that series I just showed before, the line that went from 40 to 1 to 200 to 1 to 400 to 1. This is the idea multiplier. See how it leads the rate of commercial innovation in the world by at least 5 years. This is something that we did not set out to find, but that's something that we have been shocked and ultimately is starting to alter our thinking. And in fact, I'm bold enough to say in front of you today that not tomorrow, not today, not tomorrow, not this year, but in 5 years' time, this increasingly widely accepted concept that we call the new normal of a world stuck in a very low and constrained opportunity world, that world is ending. Because this line says the rate of commercial innovation that ultimately impacts all of our businesses, that line is going to turn up. And finally, I'll leave with you, I think just as important slide. This idea multiplier gives us some sense of not only when commercial innovation will pick up, when growth will significantly accelerate in the world, it also tells us potentially where, in what fields, the next game-changing ideas will come. As I mentioned before, this idea multiplier accelerated in the field of computer and telecommunication technology in the early 90s, 5 years before the commercial spreading of the internet in the late 90s. So I asked the team, are there any fields today that have an idea multiplier significantly higher than what the idea multiplier had before the internet came along, which effectively predicted the commercial rise of the internet? When the team came back, they told me that they had found not just one, they had found 5. Here are the 5 fields where very likely the next game-changing idea, potentially on the level of the internet, are potentially coming. These are the 5 fields. This is where the idea multipliers have an extremely highly charged state that are higher today than where computers were in the early 1990s. Encouragingly, and I'll conclude with my daughter's question, areas such as telecommunications and sensors, right? Potentially the Internet of Things. Again, this does not tell us what companies, what actual products. I have no clue. But this tells what fields the next game-changing ideas will come from. Polymers and materials, this is very likely around battery technology and carbon fiber techniques. Agriculture and plant science. This is important because this does not just mean new cool technologies. This means potentially helping to address some of the most pressing challenges in the world, including food security and food quality. Food as a technology. This field is highly charged. Oncology. I personally have had multiple family members suffer from cancer. This is extremely encouraging to see. But finally, the one field that we believe is the most likely to potentially and respectfully change the world in a way more profound than the internet, it is genetics. Because in 1992, the field of computer and telecommunication technology had an idea multiplier of 300 to 1. You know what the idea multiplier is for genetics today? 4,000 to 1. That is an idea worth spreading and means something, and for the first time in a long time, as I told my daughter that evening, for the first time in a long time, I actually have hope on our economic future. Yes, McKenna, as a parent, you have to tell the truth. There will be challenges in the years ahead. But for the first time in a long time, I see the world getting better, and it's going to be a future that we will all live to see. Thank you very much.